Welcome to the deep dive. Today we're cracking open a really fascinating document. It's like a time capsule of post-crisis finance, the 2012 Shareholders Letter from JPMorgan Chase.
Yeah, it really is.
Our mission here is to kind of cut through the corporate speak and figure out what it really means when a huge global bank is, simultaneously hitting record highs, but also dealing with these massive, embarrassing failures.
And this particular letter, it's just a goldmine if you're looking at organizational risk, resilience, that sort of thing.
Right.
It lands just as the whole industry is grappling with hundreds of new rules, Dodd-Frank, Basel III capital requirement.
All that post-crisis regulation.
Exactly. And the global economy is still pretty shaky. So you've got this management team under intense pressure, trying to look strong on the outside while, well, dealing with some serious internal weaknesses.
And externally, the numbers look incredible, didn't they? Let's just lay out that financial picture first, because it really frames the scale of the failure that came later.
Good idea.
So they reported a record net income, get this, $21.3 billion on revenue of $97 billion for 2012.
It's huge numbers.
And it wasn't just a one-off. It was their third year in a row hitting record net income and getting a return on tangible common equity of at least 15%. Pretty impressive.
And when you're talking about success like that, you got to look at how they measured value. They really pushed their tangible book value, TBV. It's kind of the gold standard for conservative valuation, right? Since their big merger back in 2004, that TBV grew at 15.4% compounded annually.
Wow.
Now, to really get how good that is, remember the S&P 500. Over that same time, it only managed like 4.8% gain.
Big difference.
Huge. So over 8 years, the bank's TBV up 237.2%. The market, which is 49.2%. The message was clear. Our success is solid, not built on air.
And that success relied on just staggering operational scale. Look at the real-world impact in 2012. The firm put out over $1.8 trillion in credit and raised capital for clients globally.
Yeah, that's like the oxygen for the economy, isn't
Yeah.
it? And the sources, they break down where that oxygen went. Like $20 billion for small businesses, that was up 18% from the year before.
Important for recovery.
Definitely. And they originated over 920,000 mortgages.
Yeah.
Helping stabilize housing. Plus, something like $85 billion in credit and capital went to nearly 1,500 nonprofits and government entities. We're talking hospitals, universities, infrastructure.
So that scale, you see why these places are just fundamental to how modern economies work.
Absolutely.
And the letter actually connects this scale to what they saw as future global needs. They projected that between 2012 and 2030, the world would need something like $57 trillion for infrastructure.
Wow, $57 trillion.
Yeah, that's 60% more than the previous 18 years. You need institutions this big with this kind of capital base to even think about facilitating that kind of global growth.
And bringing it back to the U.S. picture, the letter was, well, cautiously optimistic about the consumer. The economy was healing, they said, and consumers looked healthier.
How did they measure that?
The key thing they pointed to was the consumer debt service ratio. It had peaked really high, like 14.09% in 2007.
Right before the crash.
Exactly. But by 2012, it was down to 10.3%. That was the lowest number since 1980.
Okay, so that's a significant recovery.
Massive recovery and stability, yeah. But they did point a finger at political gridlock, said it was still holding back growth, eroding business confidence.
Always something, right. And that need for stability means being ready for crisis. They talked about supporting European clients through all that economic stress over there, but also preparing for black swans, the unexpected disasters. They listed the usual things, natural disasters, geopolitical stuff, but also ominously mentioned man-made events like flash crashes. They seemed very focused on external threats.
Which brings us to the massive irony, doesn't it?
Yeah.
You spend all this energy building defenses against dangers from the outside.
And then the big one hatches right inside your own house.
Precisely.
Okay. Let's pivot then. Let's talk about what the CEO himself called the stupidest and most embarrassing situation he'd ever been part of, the infamous London whale.
Right. The Chief Investment Office, CIO, the division that took this massive loss. The fallout was, well, immediate and crippling.
How bad are we talking?
Multi-billion-dollar hit, obviously. Huge damage to the bank's reputation. And it kicked off multiple ongoing legal and regulatory investigations. That's crucial.
Okay.
And it forced these regulatory consent orders, which are basically, court-enforced public admissions of failure. They demanded huge supervised changes internally, not just for the CIO, but also covering mortgage foreclosures and anti-money laundering. Big stuff.
So what was the initial mistake? The letter blanks complacency. Says this synthetic credit portfolio worked for years as a hedge.
Yeah, that's the official line.
But then they say a new strategy was devised, which actually added to the risk. And this new strategy was, quote, flawed, complex, poorly reviewed, poorly executed, and poorly monitored. But just calling it complacency, when a portfolio that big loses billions, doesn't that feel a bit simplistic? Like it points more towards, I don't know, management ego maybe? Blind trust?
I think that's the critical point, isn't it?
Yeah.
The letter uses complacency, maybe as a bit of cover, but the lessons they say they learned, those tell the real story.
The lifelong lessons, yeah.
Right. And the real takeaway isn't just the list itself. It's the sheer embarrassment that a global bank hitting record profits had to write these things down like they were, startling new insights, not just basic blocking and tackling.
Like risk management 101 stuff they forgot.
Kind of. They had to teach themselves publicly to fight complacency, to overcome conflict avoidance, basically saying, hey, asking tough questions isn't rude, it's necessary.
And the big one you hear again and again in these situations, trust and verify.
Exactly. That's admitting that no matter how much you trust someone in a system moving trillions, you absolutely need robust checks and balances. No exceptions.
Okay, so that leads to accountability. And how they handled that in 2012 was, well, pretty groundbreaking for the time, wasn't it?
It really was. The management team responsible. Gone. Replaced. CEO and CFO. Took pay cuts.
But the big headline.
The big one was the money. They used comprehensive clawbacks to recapture over $100 million in previously granted bonuses and awards from executives.
Wow, over $100 million.
That is an enormous amount. It sent a huge signal. Messing up on this scale wasn't just bad for the bank. It was going to be a personal financial disaster for the people in charge.
That kind of accountability, it must have triggered a massive shift internally, right? Suddenly, this whole control and regulatory agenda becomes priority number one.
Absolutely. All hands on deck. Think about the sheer effort involved, complying with literally hundreds of new rules coming out of Dodd-Frank, Basel, other global regulators. It's almost a paralyzing amount of work.
So how do you even manage that?
Well, they essentially built a new internal police force, created this firm-wide oversight and control group. It reported directly to the COCUOs, had clear command control authority,
Wow.
and every single line of business, mandated to appoint its own dedicated control officer. It was basically admitting central risk management had failed and needed rebuilding from the top down.
And this whole situation, of course, brought up the too big to fail ghost again.
Always does.
The letter tackles it directly, though, argues that the new powers under Dodd-Frank, especially those mandatory living wills.
Right, the plans for how to wind down a bank without wrecking the economy.
Yeah. They argued those tools created the conditions to actually eliminate too big to fail. So major banks could, in theory, go bankrupt without needing taxpayer bailouts.
A necessary argument for them to make, politically and practically. They needed that internal fortress wall, sure, but they were also fighting external threats. The sources really emphasized cybersecurity, noting that the whole threat landscape had changed. It wasn't just, lone hackers anymore. Attacks were becoming state-sanctioned and coordinated, designed specifically to disrupt services or steal valuable IP. Big league stuff.
And they put their money where their mouth was.
Seems like it. Back in 2012, they were spending around $200 million a year just on cybersecurity, had over 600 people dedicated to it, and they expected that number to grow dramatically.
That's serious investment.
And they made this huge promise to clients, basically saying you wouldn't be responsible for any losses from cyber attacks. That alone shows how high the stakes were for keeping that digital infrastructure safe.
Okay, so shifting gears a bit, looking towards the future, strategically. The letter talks about how their massive scale gives them a competitive edge. Integration seems key.
Totally. Check out this stat. The average corporate client uses 4 of the firm's products. Okay, not bad. But the average consumer household uses 8 Chase products and services.
8. That's
Yes.
sticky.
Very sticky. That depth translates directly into revenue. They figured cross-selling and synergies across all their integrated businesses brought in about $14 billion in revenue, plus another $3 billion in cash savings. The argument is only scale allows that kind of synergy.
Makes sense.
And strategically, they were also playing defense against a major future risk. Interest rates going haywire.
How so?
They deliberately set up the bank to actually benefit if rates rose rapidly. They calculated that if rates jumped 300 basis points, that's 3% in a year.
Which seemed possible back then.
Yeah, definitely a concern. Well, that jump would increase their pre-tax profits by about $5 billion.
Okay, so that's a massive built-in cushion.
Exactly. Not just nice to have. They saw it as a critical buffer against other potential bad news from, global instability.
And that idea of resilience, it wasn't just financial engineering. We saw that huge balance sheet put to work during Superstorm Sandy, right? Late in 2012.
Oh, yeah, that was a big test.
The firm was absolutely crucial in the immediate aftermath, handing out over $1 billion in cash from ATMs and branches when the power was out everywhere.
Incredible logistical feat.
They sent out mobile branches, committed an extra $5 billion in capital to help small and medium businesses get back on their feet after the physical destruction.
And that connection to community safety, that's what gives institutions this size some legitimacy, isn't it? When the lights go out, people need cash, fast. And few others could handle that kind of emergency response on that scale.
So, wrapping this up, what's the big picture from this 2012 letter? It leaves you with this really stark image, doesn't it? A bank that's simultaneously, too successful to fail, but also maybe too complex to perfectly control, hitting record profits, celebrating huge market share, and yet forced to publicly admit these deep internal failures, ethical failures, operational failures, costing jobs, costing executives over $100 million in clawbacks. It's quite the paradox.
It really is. And the firm commits, to being a port of safety in the next storm, acknowledging that running something that moves maybe $10 trillion a day, operates in over 100 markets, it demands not just smarts, but also the humility to know mistakes will happen.
So we heard about needing to build this fortress wall internally and the importance of trust and verify after that huge self-inflicted wound. Here's something for you to think about. Given the sheer exponential scale and speed of global finance now, the sophistication of state-sponsored cyber threats, the complexity of just knitting together thousands of business units, is it actually possible for any organization this massive to truly maintain that fortress wall, to consistently keep its mistakes small? Or is some kind of catastrophic failure almost an inevitable byproduct when you reach that kind of unprecedented global scale? Something to mull over as you think about the future of finance and risk.